All right, welcome to The Explainer. Today we're going to tackle a really big one. A sector that's both powerful and, let's be honest, kind of complex. Indian banking. We're going to break it down into its three core pillars, so you have a crystal clear framework for how it all works and what makes each part tick. So you're thinking about investing in India, right? You see this massive banking sector. It's the lifeblood of the economy. But man, it can feel like a maze. With so many different names and banks, where do you even begin? Well, that's exactly the problem we're going to solve for you right now. Okay, so let's break it down. When you pull back the curtain, this whole huge landscape really boils down to just three main groups. You've got your 12 government-owned public sector banks, you'll hear them called PSUs. Then there are 22 private sector banks, and finally, 12 small finance banks. Now, the key thing to get is that each of these groups has a totally different DNA, a different mission. So, let's meet our first player.
First up, the public sector banks, or PSUs. You got to think of these guys as the bedrock, the absolute backbone of India's financial system. The government owns a majority stake, which gives them this incredible stability and a reach that stretches into every single corner of the country. They're the reliable giants.
So, let's get into what really makes a PSU tick. Because they have this social mission and are tied to the government, they tend to have higher costs. And, historically they've had some struggles with credit quality. But, and this is a huge but, here's the other side of that coin. They get direct capital injections from the government. That is a massive safety net. And their reach, especially out in rural India, is just something no one else can match.
So for an investor, this is the core trade-off you have to wrap your head around. The strength is just undeniable, right? Government backing equals stability. And because they've been beaten down, their valuations are low, which means there's a huge potential for a comeback story. But what are the challenges? Well, they can be slow, a bit bureaucratic, and they've spent years cleaning up a backlog of bad loans, what we call NPAs.
And this number, this is everything to their turnaround story. Over 70%. That's the provision coverage ratio, or PCR. Now, what is that? Just think of it like a bank's personal emergency fund. It's the money they've already set aside to cover any loans that might go bad. So when you see a PCR this high, it's a huge green flag. It tells you the bank has done the hard work, they've cleaned house, and they're standing on much, much healthier ground. It is the metric to watch for PSUs.
Okay, so that's the story of stability and recovery. Now let's switch gears and meet our second player, because it's a world of difference. These are the private sector banks. If PSUs are the reliable giants, these guys are the sleek, tech-savvy, super efficient engines of the industry.
And look, their success is no fluke. It's built on a pretty clear foundation. Professional management that's all about performance, a total obsession with technology and digital leadership, and, this is absolutely critical, way better systems for deciding who gets a loan. They're just masters of managing risk. Okay, so what's the catch? Sounds perfect, right? Well, you get what you pay for. The strengths are obvious. They make more money, they're run by top-tier professionals, they lead in tech. But the risk? Everybody knows this. So their stocks are expensive, they trade at a premium. The competition is absolutely brutal. And let's not forget, banking is still banking. It's a cyclical business that goes up and down with the economy.
So if the magic number for PSUs was all about recovery, for private banks, it's all about quality. And this is the number you need to know, over 15%. That's the gold standard for return on equity, or ROE. This number isn't just about growth. It proves that the bank is making money smartly. It's a sign of incredible efficiency, showing how well they use their shareholders' money to generate profits. It's really the signature of a high-quality private bank.
And that brings us to our third and final player in this game, the small finance banks, or SFBs. These are the scrappy challengers, the nimble, high-growth upstarts. Their whole reason for being is to push into new markets and serve the people that the big banks haven't reached.
Yet their business model is totally unique, and it's heavily regulated. They have this rule. At least 75% of their loans must go to what are called priority sectors. We're talking about things like agriculture, small businesses, the real grassroots economy. This means they are laser-focused on bringing banking to tiny businesses and regions that, frankly, the bigger banks have often ignored.
And really, at their heart, SFBs are the living, breathing embodiment of this one big idea, financial inclusion. Their entire purpose is wrapped up in this mission, making banking services accessible and affordable for literally everyone, and turning what used to be just a social goal into a real working business model.
Okay, so we've met our three key players. We've got the stable backbone, the efficient innovator, and the high-growth challenger. Now for the fun part. Let's put them all together and build a playbook for an investor. How in the world do you choose between them?
This is where it all comes together. Think of it like a tale of the tape. You want explosive growth? You look at SFBs, but you have to be okay with higher risk. Are you looking for top-notch quality and great management? Well, private banks are the leaders there, but you're going to pay a premium for it. Or maybe you're a value hunter looking for a comeback story. That's the PSU play with their improving books. It really truly comes down to what kind of investor you are.
So how could you actually put this into practice in a portfolio? Well, here's one way to think about it, kind of like a recipe. You might use private banks as your solid core. That's 40 to 50%. Then you'd add a chunk of PSUs for that value and recovery angle, say 30 to 40%. And finally, you sprinkle in a smaller slice of SFBs, maybe 10 to 20% for that high-octane growth. It's a way to try and capture the best of all three worlds.
So when you boil it all down, it's a pretty simple three-step process. Step 1. Figure out your goal. Are you after value, quality, or growth? Step 2. Match that goal to the right type of bank, PSU, private, or SFB. And step 3. The most important part, use the right report card. Monitor them with the right metrics, like PCR for the PSUs and ROE for the private banks.
Look, when you zoom out from all the details, the biggest takeaway is this. You're not just looking at 46 different banks. You're looking at 3 totally distinct groups, each one serving a different purpose in the economy and each with its own unique risk and reward profile. And understanding that difference, that's the key. That's what lets you build a smarter, more resilient portfolio, because you can diversify across all their unique strengths.
And all this leaves us with one massive, fascinating question for the future. You've got these 3 powerful forces all at play at the same time: the great recovery in PSUs, the relentless innovation from private banks, and the mission of inclusion from the SFBs. So, which of these powerful stories is going to be the one that defines India's next decade of growth?